When it comes to any investment party, the two most unwelcome guests are Old Man Inflation and Uncle Sam. The Federal Reserve has told us that inflation is 2 years away from showing up. If the Fed is correct, then all we have to do is worry about Uncle Sam. Unfortunately, he'll be pulling into your driveway sooner than you think. If you are a Maryland small business owner, you know that Uncle Larry has already rung your doorbell. Please do not make the mistake of thinking these guys are lost or just in the wrong neighborhood. The real concern is when both uncles move in for the foreseeable future. The question is, what are you going to do about it? The best way to deal with unwelcome guests is not feeding them. In this case, it means not letting the uncles tax you by shifting assets to vehicles that are not taxable. The Roth IRA is getting a lot of attention, and rightfully so. The Roth IRA is great regardless if you're a young adult or a retiree with some earned income. The main benefit of a Roth is that if you hold the account for 5 years and you've attained the age of 59 and a half, then any growth in the account is not taxed upon distribution. For the young adult or even teenager, the Roth IRA offers liquidity prior to retirement. If you don't currently have a traditional IRA, but are not eligible to make a Roth IRA contribution, consider a Backdoor Roth IRA. A Backdoor Roth IRA is a non-deductible IRA contribution followed by a Roth conversion. If there are no IRA account balances prior to the non-deductible contribution, then there are generally no taxes due upon the conversion. If you're eligible to fund an annual Roth IRA contribution, or you can do a Backdoor Roth IRA, then that's a no-brainer. However, a lot of folks are considering Roth conversions. Some have such a disdain for taxes that they're willing to convert a sizable amount in regular IRAs to Roth IRAs and pay a lot of taxes this year to get rid of the taxes forever on this portion of the assets. While I understand the motivation, extreme caution should be exercised. There are a lot of variables to this decision, including new or increased tax credits such as the child tax credit and the child care credits that may be lost if your income is too high due to the Roth conversion. And who knows, there might even be a fourth stimulus payment that you may not want to jeopardize. There's also a rule that most experts agree on. If you're going to do a Roth conversion that will cause a taxable event, payment for the taxes must come from outside the retirement accounts. If you would like to discuss how we can help you enjoy the fruits of your labor and reduce your exposure to these unwelcome guests, please give us a call. We'd be honored to have such a conversation.